On the evidence of broad indices, markets were reasonably calm in the third quarter. The MSCI World Index of developed markets returned 5%, continuing its outperformance of emerging markets, which were down 1.1%. While bond markets were mixed, most government markets were down 1%, whereas credit outperformed with high yield bonds returning 2.4% and emerging market debt 1.5%. However, these broad indices hit a number of undercurrents which reveal a wide divergence of returns and some developments to worry investors. Returns in equities were again dominated by the US, up 7.6% in the quarter, while the rest of the world was flat. Within equities, growth stocks materially outperformed other style factors, especially value, continuing a trend that has persisted for most of the post-crisis period, leading to stretched valuations across many growth stocks. The Momentum Global Managed Solutions, Global Cautious, Managed and Growth, all delivered positive absolute returns in the third quarter. Cautious was up 0.2%, Managed 1.3% and Growth 2%. The funds comfortably outperformed their target outcomes by an average margin of 1.2%. All three funds are currently ahead of their targets over their recommended holding periods net of all fees, because Cautious has returned 4.5% per annum over the past 3 years, Managed has returned 4.9% over the past 5 years, and Growth has returned 9.3% per annum over the past 7 years. Since inception, the funds are ahead of their targets, again net of all fees, of between 2 and 5% annualised. Year to date, however, the funds are behind their target outcomes, and the key drawback has been asset allocation within equity and are underweight to the US. Gold has detracted from performance too. Both positions continue to justify their roles in portfolios today, and hence we don't elect to make any changes to the fund's positioning currently. The fund's underweight allocation to US equities has detracted from performance in recent months, but stocks in the UK and in particular Japan performed strongly in September. Emerging markets remain volatile, but given the extent of their recent underperformance, we think they now offer an attractive entry point. We've been surprised by the extent of the US stock market's outperformance lately. The US stock market includes many of the world's best companies, but even after allowing for this fact, we believe prices are expensive and hence we hold an underweight allocation to the region. And this detracted from performance in the third quarter. The key positive contributor to performance was underweight fixed income, particularly government bonds. This part of our investment thesis, that government bonds are expensive and therefore offer poor prospective returns for investors when taking inflation into account, has played out as we expected, and our decision to largely ignore these widely held assets has been the biggest contributor to performance over the past 12 months. Our underlying managers underperformed in aggregate between June and September, but have added a lot of value over the past 12 months. We increased our core dollar-denominated emerging market debt exposure during the quarter as spreads widened, and higher spreads mean greater compensation for risk. We also added a new strategy managed by Jupiter, which focuses on owning shorter maturity bonds issued by companies in emerging market. Although the global economy generally is in good shape, with reasonable growth combined with low inflation, it's not a time for investor complacency. Some of the negative developments in recent weeks, such as the EU's problems regarding Italy and Brexit, could be of a relatively short-term nature, but it's becoming increasingly likely that the trade war between the US and China will persist for some time and could have a rising impact on confidence and growth. Most importantly of all, the US Federal Reserve will continue to tighten policy by increasing rates, probably to over 3% by the end of 2019, and also by removing liquidity through other means. Bond yields could well rise further, putting pressure on other asset values, and those countries, companies and households with excessive debt face difficult times ahead, and much greater caution is warranted with respect to credit risks in portfolios. It will be important to watch for signs of any pickup of inflation in the US, notably in wages, as this would be a potential trigger for an unexpectedly sharp tightening of monetary policy. However, there are few signs currently of excess or capacity shortages which might trigger an inflationary surge, and perversely, the factors which are worrying investors could provide the brake which constrains growth and inflation to sustainable levels for some time ahead. There are good reasons to expect a period of bumpiness in markets, but the cycle has further to run. With monetary policy set to tighten further, this remains an environment to keep duration short and progressively move away from credit into government bonds. Greater resilience is warranted in portfolios, and there are ample reasons for a more cautious approach, but there are still attractive investments across many equity markets, and the inevitable setbacks will present opportunities to add to positions selectively.